AJ Bell, and I'm joined today by Terry McGivern, a fund manager for passive portfolios at AJ Bell. Thanks for joining us today.
Thanks for having me, Laura.
So what was the performance of the funds like in the final 3 months of 2019?
We were really pleased with fund performance in the last quarter of 2019. All funds posted positive returns. Those on the lower end of the risk spectrums, the cautious funds and the moderately cautious funds, saw smaller gains than those higher up the risk spectrum, such as the adventurous fund or the global growth fund. And that's more of a function of the fact that stocks had the best of the quarter, really, relative to bonds, which saw, while still seeing some positive performance, didn't have as good a quarter. So those funds lower down the risk spectrum, which obviously hold higher weights in bonds and defensive assets, saw smaller gains than those funds that are higher up on the risk spectrum, such as the adventurous and global growth funds, which hold higher weights in stocks.
And how did that affect the full year performance for 2019?
Yeah, so on a calendar basis for the full year, performance has been really strong. We're really pleased with the performance that we've seen. If you look at the cautious funds at the lowest end of the risk spectrum, that's posted returns of over 10% in the calendar year, which is, quite strong. And then if you look at those at the higher risk spectrum, such as I mentioned before, the adventurous and the global growth funds, they've posted returns of over 19%. Now, them sort of returns would be at the top end of what we expect in any 1 year on the funds, which just goes to show that it has been a really strong quarter and a really strong calendar year for risk assets and financial markets in general, really.
We saw a rally in stock markets after Boris Johnson's win in the general election, but what particular asset classes did that benefit?
Yeah, so UK stocks were a big beneficiary of the general election result. In particular, the FTSE 250 index, the sort of mid-cap and the companies that have a greater exposure to the UK economy, as opposed to your mega caps and things that are in the FTSE 100, which may be a little bit more exposed to global growth. We see that was where we saw the biggest impact. In the 2 days post-election, the FTSE 250 index was up over 6%, which is a significant bounce, and it closed up on the quarter around 10% or just over 10%. So it was a really notable bounce, which we've seen in that mid-cap sector, particularly on UK stocks. And we do hold exposures right through all of the fund range in that sort of area, so we were a beneficiary in the funds of that bounce. Yeah. So another area that we saw do really well in the aftermath of the election was with pound sterling. We started to see a run-up in sterling ahead of the election, as basically Boris Johnson was installed as the favourite, and he was expected to win the election and possibly get a majority. So we started to see that move in sterling, and then post-election it really sort of popped. So over the quarter, relative to the US dollar, sterling posted gains of around 8%, which is pretty significant because it has, over the course of the last year or two, been a little bit beaten up. So it was different to see that come through, post-election. One thing that we need to be aware of in the portfolios, however, is that while sterling gains are good for those of us going abroad on holiday, in terms of our foreign currency, which we can transfer and we get more for our money, it's not great for investors who receive returns from outside of the UK, because they have to be translated back into the home currency. So there were areas of the portfolio that had done well, such as emerging market bonds and global high yield. But once you take into account the appreciation in sterling and the conversion back, the returns were not so good, and we actually saw emerging market bonds, which were positive in local currency terms, actually post negative in sterling terms. The other area of the portfolio, so global high yield, which I mentioned there, which ordinarily we would have seen it not do so well on the back of the sterling translation. In the portfolios, we do have a sterling hedge on that exposure, which means we didn't suffer from the appreciation in sterling, and we were able to retain the full gains that we saw in local currency terms on global high yield bonds.
And are there any assets that didn't fare so well?
Yeah, so UK gilts were a significant faller on the quarter. Post the election result, you've seen a return of investor confidence, really. And when you got that investor confidence in the economic scenario and the economic situation, you generally don't see investors wanting to go into safe defensive assets. They want to go into risk assets, which is exactly what we're seeing with the FTSE 250. And that meant that UK gilts really suffered. They were down over 4% for the quarter. Fortunately, we do have a tactical asset allocation tilt on UK gilts. So where we do hold them in the funds, or we have to hold them in the funds, we do hold the shorter dated maturities, which means that they're less exposed to price changes as a result of interest rate expectations. And that meant that we were insulated from the worst of the falls. But UK gilts as an asset class did suffer in the wake of the election.
Have there been any significant changes to the funds or anything that investors should be aware of?
There were no changes that were driven by decisions that we made within the team. We were comfortable with the asset allocation at the start of the year. We were comfortable with it throughout the year and going into the UK general election. We were also happy with the holdings which we used to gain our exposures. But one change that was forced upon us was the closure of a range of funds provided by a Canadian provider, BMO. And now BMO have a UK ETF range, and we used one of their products, which is the Global High Yield Bond product. It's a sterling hedge product, like I mentioned earlier. And unfortunately, the closure of their range necessitated us finding another product to fill that gap, really. We moved into the iShares Global High Yield Sterling Hedge product as a replacement. Very similar exposures. You know, we're happy that there's no real change to the funds or what our investors are exposed through as a result of that change. So that is the only change that was made in terms of holdings in the funds. A couple of other areas that we need to note some changes though is our investors will have been made aware of the fact that we are making some changes to the naming convention on our funds. We're dropping the passive title out of the AJBL fund range. And there's a couple of reasons of that, around that which I'll go into. We're also adding swing pricing mechanism, which should help insulate our current investors from the cost of dealing for new investors who are coming into the funds. And we're also clarifying a little bit of the text around the prospectus, really, just to give our investors a little bit more information as what's an appropriate comparator for them to look at on a performance basis. Now, with regards to the passive fund changes, they were all made on the 6th of January, so Monday just gone, and they're live then from that point going forward. And the reason that we've made some of these changes, the main one really is the dropping of the passive name. We do feel that it's got negative connotations. You know, from our market research that we've carried out, people see passive as being almost a bit of a negative with respect to investment products. Some people see it as a set and forget and maybe don't think that there's a hands-on approach, and care being provided on them products. So we believe that given that we do have what I would describe as an active asset allocation. You know, I mentioned before we have a tactical overlay which we utilised on UK gilts. We do set the asset allocation at the start of the year each year. And we are quite active in our underlying selection of products that we're using. So whilst it's index products that we use to affect our exposures, it is actually relatively active on the allocation side, which we felt that passive doesn't really convey that, how that we are the way that we are managing the funds at present. So we took the decision to drop the passive label from the names. On the swing pricing changes, as I mentioned, that's to insulate current investors from the cost of dealing for new investors who are coming into the fund. In a growing fund range like ours, where we see mainly inflows, it's tough for us to net out against outflows. So we basically have to use that cash that's coming in constantly and has to be put to work to buy new stocks and new holdings. That incurs dealing costs, which we don't believe our current investors should have to bear. So by introducing the swing pricing mechanism, any new investors or leavers out of the fund are basically paying for the costs of actually dealing for their money coming in or leaving, and our current investors aren't diluted. So there's a couple of changes that we're making that we think make the funds much more investor friendly, as well as giving our investors a better idea of what is actually happening and how we're managing the funds.
And finally, looking ahead to the next 12 months, what's in store for 2020?
Yeah, so in 2020, there's a couple of things that we need to be aware of, some big geopolitical events really. The main one, I think, we're pleased to see some clarity on the UK political front. I think that will fill investors with confidence. We've seen it already in December. I think we will see that continue into January. Boris Johnson's new government has got a couple of things to get over in terms of steps. So they've got to pass the withdrawal agreement in January, which will mean that the UK legally leaves the EU on the 31st of January 2020. After that, then there's the step of negotiating a full trade deal before the end of the transition agreement, which is the end of 2020. So we'll be keeping a close eye on developments in that sort of space to see, how things are developing and whether we're going to end up in any sort of logjam around the Brexit question, which will impact obviously UK assets. There's a couple of other areas that we need to be aware of as well in terms of there's been an ongoing trade dispute between the US and China, which we've seen throughout 2019. There hasn't really been a resolution of that just yet, so that is still simmering along in the background, and it does have an impact on global markets when the two largest economies on earth are basically not getting along, so we do need to be cognizant of that. At the same time, we've seen pretty strong returns in stock markets in 2019, which means that valuations where they are today at the start of this year are stretched further again than they were at the start of last year, which means that we do need to be cognizant of that fact. And it's something that we are paying close attention to in our asset allocation process going into 2020. And then finally, the US presidential election race is going to be something which I think everyone will be paying close attention to. It does have the potential to introduce a lot of volatility into markets, dependent on whether markets believe that President Trump is going to be re-elected to the White House, or whether there's going to be a replacement which could be significantly different in terms of what that means for financial markets going forward into 2020 and beyond.